Julia, let me start with you on the economy. I've seen second quarter GDP figures now of -10, -13%. Is that outlandish or totally feasible?
It's not outlandish. When we're talking about the economy effectively grinding to a halt right now as we speak, and this is going to last at least several months, I don't think it's outlandish to think we're going to see some of the biggest one-quarter drops we've seen in the post-war period.
And, this sets up for a unique challenge because it's almost like the country was hit by a virtual meteor, right? So there's a lot of talk about what happens kind of in the rebuilding effort, right? And in a way, that could be as tricky a period of time if you're in the market, for example, but trying to figure out inflation and how to unwind some of these programs. I know I'm way ahead of myself here, but it's going to be a dicey few months.
Yeah, no, it's a liquidity crunch in the real economy. So businesses are looking at revenues just stopping on a dime, and households, meanwhile, still have rent to pay and mortgage payments to make. So it really is something that can feed on itself, and it's the goal of policy right now should be to short-circuit that feedback loop. And if you think about the scope of this and the scale and the speed with which this is happening, it's going to take a lot of money, even more than they're talking about on Capitol Hill right now, and more from the Fed. And it's rippling through financial markets in a very insidious way. We're hearing about deleveraging and forced selling.
Right.
We're seeing breakdowns in the correlations between stocks and bonds. So we really are at a moment where this could feed upon itself in a very bad way, and policymakers need to just break it all out, be creative, go big, and arrest this feedback loop.
Jason, let me bring you in on that note. Are you someone who would also say this is the time not to worry about the dollar figure per se, because the cost is going to be huge if we do nothing? I don't think people understand what a recession means for the budget, for the deficit, for the debt. I mean, it could be spend less now to spend less now on that front, or spend a whole lot more later if we can't get this thing back on track pretty quickly, right?
I think that's right, and I think there's been a very big change in the administration itself just in the last 2 weeks, certainly in the last 4 or 5 days, where there was some talk of targeted stimulus, a week and a half ago, and now it seems to me this is like Draghi said in 2012. This is very close to the whatever it takes moment. You've passed an $8.5 billion spending bill. $105 billion spending bill is about to be passed, and you're talking about $1.2 trillion. Julia may be right. It may need to be more. It seems to me, though, that there's no upper bound in what policymakers are willing to do now,
Jason,
especially with 10-year Treasury yields as low as they are. There's not much cost, I would argue, for doing whatever it takes.
People will push back. They're already pushing back, I think, in part because we haven't seen the hit yet that's coming to the economy, and say, how can you say open-ended? How can you be throwing around multi-trillion-dollar figures out there? Explain why, and maybe this is dangerous, and that's why we have to worry about what this will look like on the other side, and maybe that's why the bond market's already going a little haywire.
Yeah, well, it clearly, this is a form of modern monetary theory. There's no two ways about it, and that can be somewhat worrisome as far as inflation is concerned later on. But by the same token, we have to get, I would suggest very much a one day at a time approach. And, as Sinatra said, I'm for whatever gets you through the night. I'm very much for whatever will work in the next couple of months, so the liquidity crisis doesn't become a solvency crisis, which it seems to be morphing into if we're not careful. So you've never seen, it's cliche to say it's unprecedented, but you've never seen largely a government not mandated because we have a free economy, but largely mandated demand shock.
Exactly, and they have to compensate people for that.
That's
you can't
why
order
you have
things
to go
closed.
for it.
Right, exactly. And let me ask you too, Jason, because we're running out of time. This Bernanke-Yellen op-ed in the Financial Times, I want to make sure everybody knows about it and reads it. Along with the litany of things they recommend, they do say the Fed could, and in fact, you could say they're saying they should buy corporate debt. Would you agree with that?
I would. Again, it's hard to be. There's no atheists in foxholes here, as they say, and you can't be intellectually pure. It's not what the Fed was designed to do, but again, this is different, and I would suggest I would want to make it a permanent feature of our central banking. But if you're going to pull that, if you're going to pull that lever, this is the time to do it.
Okay, and Julia, I want to make sure everyone heard what you said because I thought it was the best encapsulation of this I've heard yet. Quote, a liquidity crunch in the real economy. And that helps explain why we're trying to get liquidity to households directly, right? No matter, however that has to be worked out. Yeah,
absolutely. And in addition, let's throw in municipal bonds in there. State and local governments are on the front lines of addressing the health aspect of this, and they're going to need access to funding. Give the Fed the authority, at least temporarily, to help finance them. That will can help a lot of problems and help us get through this.